and thank you for tuning in to the update with Oakwood Financial Group. I'm Joshua Dobi. Thank you so much for your time to sit with us here and give some thought towards where we've been here, as I know it's going to seem hard to believe. We have crossed over the halfway point in 2021. I'm shaking my head because I can barely believe it. I feel like we just got through the Christmas and New Year's season, and here we are, July 4th, and cruising right into the second half of 2021. So pretty amazing stuff. But I wanted to take a few moments and to chat with you here about what happened a little bit in the first half, but also, and perhaps most importantly, looking ahead to what we see coming for the second half here in 2021. So I want to be respectful of your time. Let's go ahead and dive right into it. First half of 2021, a little bit of a dichotomy. You've heard me say that word a lot here, I feel like, over the last year and a half or so. But certainly we saw that again here in the first half. The first half, if you would look at the most popular stock indexes, you probably would feel pretty good about where the market was overall. The most popular ones were positive, notably so, here in the first half of 2021, and that was pretty much across the board when you're looking at whether the Dow Jones Industrial Average, S&P 500 index, or the NASDAQ Composite, in pretty positive territory. But then in a corollary or in a subsequent kind of thought process, when you look at other asset classes, and specifically I'm looking at the U.S. Treasury on the long bond, meaning the 10-year duration or longer, and then also gold in terms of its performance here in the first half of 2021, very, very different, meaning both were notably negative here in the first half of 2021. So why was that the case? What was it that transpired that made those kinds of things happen in the ways that they did? I'm going to start out with a terrible answer. It's not something we're going to be able to talk about here in just a few moments with any completeness. But what I'm going to do is to give you a couple of variables that were certainly in play, recognizing that when we're looking at market performance, we're looking at asset-based performance, there are so many variables involved in the mix that I want to be hesitant to say these are the absolute reasons why. What I can do is touch on a couple of things that we know are true here in the first half, and perhaps that can give us some thought about where we're expecting here for the second half of 2021 as well. So let's dive in terms of the positive kinds of things that we saw index-wise. Sector-wise, very, very different in 2021 than what we saw in 2020. And you've heard me say this even with regards to previous updates here in 2021. We've had a significant rotation in terms of the sectors which have performed well as compared to 2020. 2020, we had the work from home, technology, big technology companies which just exploded. And they're all the names that you know right along with me. Apple, Amazon, Netflix, Facebook, Google. I mean, all of those names which are right at the top of the list in terms of big technology companies. Huge performers in 2020. Much more modest, except for Google, in terms of, and Google is just kind of in its own universe right now in a positive way, but much more modest in terms of those companies' performance stock-wise in 2020. The new kinds of things, and I say new, I'm going to put air quotes around those, the new kinds of things which showed up in 2021, which were just decimated in 2020. Financials, most especially big bank stocks, energy companies, which were largely ignored, primarily because of the significant decrease in a barrel of oil, which we saw just about the time that things were closing down due to COVID in Q1 and beginning of Q2 last year. Really didn't hit the news all that much because of what was happening with COVID at that time, but a significant drop in a barrel of oil price just decimated energy companies last year. So when we're looking at financials and energy companies and then real estate as well, that was, again, largely ignored and in most cases had very negative performance in 2020, has just rebounded dramatically. So financials, energy, real estate, not all companies, but certainly when we're looking at sectors which have done well, those have been the sectors which have led the way here in the first half of this year. So very, very important to be aware of that. We also think it speaks very highly into the importance of diversification. If you just would have chased what happened last year, you would have missed out on a lot of this market performance in a positive way, which we have seen in the first half of 2021. So very, very important for us to always keep in mind that it's important to be diversified when we're looking to mitigate risk. You don't have to be diversified. Just know that it's very likely you're going to have more risk inside of your portfolio. So those are a couple of the reasons why we see, certainly sector-wise, the positive numbers that we saw in the first half of 2021. All right, well, what about the U.S. Treasury? What about gold? Why did they have negative performance? Don't we think of treasuries and gold sometimes as, quote, safe assets? Well, absolutely we do in terms of their market performance and correlation to what happens in the stock market, meaning they tend to be negatively correlated, meaning when the markets go down, they tend to float or even go up a little bit. But what also happens is when markets go up, they tend to remain flat or even go down a little bit. And that second phenomenon is what we saw. Now, it wasn't just due to stock market performance, but definitely the fact that we did not have a negative market event, specifically a technical pullback here in the first half of the year, definitely played into that, where especially gold has underperformed after a very vibrant year last year when it was looked upon as a store of value and definitely a safe haven against the possibility of negative market performance. But what about the U.S. Treasury? Again, the safest asset in the world, and I can say that without having to worry about any kinds of compliance issues in saying that, because it is used as a benchmark against practically every other currency on the planet, and certainly when we're talking about risk-free aspects of things, that certainly is the case with the U.S. Treasury bond. So why do we have negative performance? Well, in the short run, the reason why that was the case, a couple of different reasons why. One, we had an unexpected move up or a larger amount of growth in the interest rates than was anticipated by the market. Now, several reasons why that was the case. We're going to talk about those here in a minute in terms of the phenomenon themselves. But when interest rates go up, those bonds which are already issued or are trading in the secondary market, their values go down. Rise up in interest rates, current bonds go down in value. You may have seen that inside of some of your bond funds or bond holdings here in the first half of 2021. So that even though, again, we're looking at those as safe assets in the short run, because, again, lack of negative market event and a movement up or a movement higher in interest rates caused the value of those bonds in the short run to decrease. So we saw that, even though as a risk-free asset, we saw some depreciation in value. So when we look at that, and we look at what happened with gold, which was primarily a function of a very volatile US dollar index, we're going to talk about the reasons for that here in just a moment as well, but also in terms of not having a negative market event. Then we saw a depreciation in the spot price of gold or in the trade value of gold as well. So what does all of that mean? So we've taken a look a little bit at what happened in the first half of 2021. What does that mean for the balance of 2021? Well, you know me well by this point. You know we can't predict those kinds of things, but there are the kinds of things which are shaping up for us as an economy, which we haven't seen for a little while here, at least in a couple of aspects. And specifically, it centers around this idea of inflation. Now, if you don't know what inflation is, then I could probably tell you in which year you were born. But for those of us who have a little bit more gray hair, or as in my instances, rapidly thinning gray hair, we know what inflation looks like. We know how it feels, and we know what the impacts from inflation can be as well. I mean, for those of you who are getting a mortgage on a home in the late 70s or early 80s, you remember vividly that it was very common, as a matter of fact, practically everybody who had a mortgage at that time had a mortgage that had a double-digit interest rate associated with it. You talk to anybody who's in their 20s and 30s right now, the idea of a double-digit interest rate on a mortgage is literally anathema. It doesn't fit their understanding or experience at any point in their lives. And yet in the late 70s to early 80s, that was absolutely true. Now, I'm saying all of that to say we're not necessarily going back to that space. As a matter of fact, that's not setting up at all that we're going to get to double-digit interest rates. I'm saying that just to provide some comparison between where we've been and where things have moved here over the last several months. And we have seen inflation. I'm using the CPI, or Consumer Price Index, which is issued by the federal government on an every other month basis, as a means of describing that. We have seen the CPI index jump, meaning that the cost of goods is jumping. We also say that from the inverse of that, saying that the buying power of our dollars or the buying power of our currency is decreasing. Those are the same things, just looking at them in the inverse. So when we see inflation, sometimes we think, well, that means that the economy is going to come to a grinding halt. Well, not necessarily true. And it's very, very important that you hear me say that. It just means that philosophically, if this is not transitory or temporary kinds of inflation, which is a term that the Federal Reserve is using a lot right now, and they're saying that this may be transitory or temporary, meaning a 1 to 2 year kind of phenomenon, that may be the case. But if it's not, then our approach in terms of investing may shift some, meaning the kinds of things that we have emphasized, say, over the last 10 years, may not be at the same height of priority as some other asset classes. Let me use a very easy example that we've seen here just over the course of the last year. In the last year, when we look at financials or energy, certainly in 2020, they were miserable in terms of their performance. Now here in 2021, where we started to get some harbingers of inflation, all of a sudden financials and energy are right at the top of the heap. The primary reason for that is, historically speaking, those sectors tend to do very well in periods of higher inflation. So again, something which maybe hasn't performed as well in a space of lower inflation may now, in a space of higher inflation, be something to which we want to give consideration. Now, all of that being said, doesn't mean that we should dump all of our investments and jump into banks and jump into oil companies. Never the case. It's never true that we should just, throw all good sense to the wind and say, well, this is where the market's going to be. Well, the market may be there, but it's not going to only be there. These are just a couple of pivot points that we're considering here at Oakwood if we stay in this kind of space from an economic standpoint. So we're watching that going into the balance of 2021. Really looking to see how things continue to matriculate in this reopening process, how this is going to feel, what things are going to move forward faster, which things are going to be slower in terms of the recovery, which things may be left behind altogether in terms of the recovery process. So we're watching those kinds of things very, very closely. In addition to that, moving on to the next idea of the things that we're watching closely, has to do with legislation coming through Congress. Now, you've heard me talk enough about legislation coming through Congress here over the last year, probably the last year lifetime. But for obvious reasons, we wanted to give attention to it because of the seismic kinds of moves and bill sizes that were moved through Congress during the last year as a result of COVID-19. But with regards to the things that are being considered now, there are proposals coming out of the Oval Office, which the Oval Office has asked for Congress to consider, and with which there are negotiations going on right now that have to do with a huge amount of spending. Whether we're talking about infrastructure, whether we're talking about social programs, and then on the other side of it, to pay for those kinds of things, looking at perhaps an adjustment, i.e. increase, to our income tax structure. These numbers that are being tossed around are literally trillions with a T. So we've gone beyond billions, we're going to trillions with a T in terms of their size. So historical kinds of bill sizes in terms of the dollar amounts being discussed. I'm not going to touch into the political aspect of things. I'm looking at this purely from a financial standpoint. And there are going to be some positives and some negatives, no matter what moves through Congress or doesn't. So it's important that we keep a balanced thought process here in thinking about what the go forward looks like. But the very least that's true is, over the last year, we have had an increase in our money supply of over 20%, meaning the number of dollars floating in circulation. It's one of the reasons why we've had a spike up in the measurement of inflation at this point. What's also true is if we get an adjustment to to income taxes, and then we see those income taxes implemented, that tends to be a pivot point in our economy where folks will tend to move away from those places, certainly if they are able, where they're being taxed more, to places where they are taxed less. And so that can be the kind of thing from an economic standpoint that provides some tilt or shift different than where we've been here, say, over the last 10 to 15 years. So very, very important items to keep in mind. We're going to be monitoring it just as we always have, especially with the items that are coming through Congress. You've heard me say this as well. How it starts on the front end is very rarely how it ends up on the back end. It's a little bit like the can and the string that we all, well, at least some of us used as kids. I know the younger ones among you may not have done that. But for those of us who attached a string to an aluminum can and held it up to our ear and tried to translate some things over distance, what starts on the front end isn't necessarily what happens on the back end. That's true with Congress as well. And so we're going to be watching those things very closely, but nothing's real until it's real. So while I'm happy to discuss those kinds of things with you, nothing has moved through the machine yet. And so we're just being mindful of the machine moving, and certainly we're going to bring those items to you as they become law, if they become law, and then describe what may be the impacts that we want to consider. So several different things that are on our macro plate, if you will, for the balance of 2021, but big things nonetheless, not only with where we've been, but also where it looks like where we're going. Well, friends, I want to be respectful of your time, as always, and thank you again for your time here and listening to our thoughts about where things are and where we see things going forward. Always, always, always feel free to reach out to us with a note, with a call, if you'd like to chat about anything, especially if you've got some ideas about how we can salvage the Pittsburgh Pirates baseball season. It's been a tough stretch as of the time of this recording in terms of the baseball season so far. I'm hoping that things change a little bit for the better. For the Pirates, we'll see what happens. We're getting ready to start training camp for the Steelers, and so a lot of excitement around that in terms of what the season may hold. Lots of new faces there, and so that's going to be fun to see as well. But like I said previously, at any time, please never hesitate to reach out to chat and to talk about things market related or not so market related. I always enjoy hearing from you. Friends, again, thank you for your time, and until the next time, I'll look forward to talking with you.